Welcome to the Chrisman Commentary Daily Mortgage News Podcast. I'm your host, Robbie Chrisman. Topics on today's episode include debt issuance tied to growing budget deficits, my interview with BankUnited's Chris Huang on trends the capital providers are seeing in mortgage originators and what to look for in bank partners or warehouse line counterparties, and President Trump's intensifying his pressure on the Federal Reserve. Do you know that Figure is shaking up the lending world with their 5-day HELOC, offering borrower approvals in as little as 5 minutes and funding in 5 days? Figure has hundreds of partners in the banking, credit union, home improvement, and, of course, IMB space, embedding their technology. Lenders give your borrowers an experience they will rave about, and you can learn more at figure.com. Remember when the bond market sold off and rates went higher due to tariff announcements? It turns out that we've seen little evidence so far that tariffs have added inflationary inertia to the mix, since imports are a relatively small part of our economy, and with all the flip-flopping, no one can remember who's paying what. Maybe we've shifted from the Fed contemplating higher for longer to higher until pressured. President Trump intensified his pressure on the Federal Reserve this week, publicly urging Chair Jerome Powell to slash interest rates between 0.5% and 1.75%. Arguing that the U.S. is losing hundreds of billions by maintaining a higher policy rate. In a handwritten note and on social media, Trump criticized Powell for being too late and failing in what he called one of the easiest jobs in America. While Trump cannot fire Powell, Treasury Secretary Scott Bessent hinted at a conventional succession plan, noting that a Fed board seat opens in January and suggesting a nominee might be positioned as Powell's successor when his term ends in May. Meanwhile, the Fed has maintained a cautious stance, citing solid labor markets and inflation still above target as reasons to delay cuts, though internal voices like Governor Waller suggest easing could begin as early as this month if disinflationary trends persist. What was supposed to be a week focused on payroll data, although I'm focused on hot dogs, fireworks, and celebrating this great country, but that's kind of beside the point, has been hijacked by speculation surrounding the eventual economic impact of President Trump's signature economic legislation, should it be signed into law after passing the Senate. Markets remain cautious due to the looming prospects of increased U.S. debt issuance tied to growing budget deficits. That would cause investors to demand higher yields, especially on long-dated treasuries, something that would cause further underperformance in the 30-year bond market. However, treasury yields dipped below their 200-day moving average to open the week, suggesting a potential shift to a lower trading range. On the trade front, President Trump announced a signed agreement with China, including commitments on rare earth exports, and indicated further deals are imminent, with other key trading partners. While this has boosted market sentiment and pressured bonds slightly, the lack of detailed commitments and lingering uncertainty around tariffs has certainly muddied the Fed's policy path. With the reciprocal tariff pause set to expire in around a week, investors and business leaders are wary of making long-term commitments. It's a work in progress. Bilateral deals may offer some clarity, but the broader risk of a return to trade tensions remains. Investors are also staying attuned to any rise in unemployment that could shift sentiment toward earlier Fed rate cuts, particularly as June payrolls are expected to show modest job growth and weakening labor market participation. For today's interview, I wanted to welcome to the show BankUnited's Chris Huang to talk about trends that capital providers are seeing in mortgage originators and what to look for in bank partners or warehouse line counterparties. He's EVP/Managing Director of Investment Portfolio and Structured Finance at BankUnited. He deals with investment portfolio and residential credit warehouse relationship management, heading up anything non-traditional in the resi space. We were talking in New York during the secondary. We've known each other for more than 10 years, back to the days when I was working at SoFi and selling you loans. You were our first real buyer of mortgages after we got our Fannie ticket, and said anything that wasn't cash window and some of the jumbo stuff, we sent it to BankUnited, and you and I have maintained a relationship since then, which is pretty cool. Maybe we'll start there. I sometimes I'll do this with people I know on the podcast. You've seen me professionally, you've seen me personally. Any difference there? I'm just unprofessional all the time. What's it been like knowing me for 10 years?
What differences are there between you in a professional setting and on a more personal? I think that's a good question. I think you tend to be the same person. It's when it comes to work, you understand when to lock in and to focus. So I've always appreciated that about you. It's been quite something to watch you, to watch a bunch of the other people we dealt with at SoFi, kind of have a diaspora across fintech, and you guys have all gotten into seats that are fairly influential, and you guys have had quite a run. The original SoFi team. So
Yeah.
it's been amazing watching you guys do all that.
Like the Rat Pack or something. But we've gone our separate ways. You're still at Bank United, which is pretty cool for longevity. I think it speaks to the culture of a place when people stay there for a while. It's not that they're looking to jump ship. It's that it's a good work environment, it's good culture, all those things. But because you've been
Hmm.
there for a while, you're also able to kind of highlight different variables that might have changed or not have changed. And that's where I want to start this interview in earnest. Trends you're seeing out there in mortgage originations, at least from the perspective of a capital provider? Any trends you've noticed?
Yeah, we're all in the residential mortgage space been dealing with this for the past couple of years, right? There's a lack of conventional volume. So we're seeing product expansion to innovative products, whether you're talking about non-QM having a ton of focus now. Products like iBuyer was popular for a little bit. You have a variety of HELOC products that have come onto the market. HEI, home equity investments, is something that has gotten a lot of focus more recently. RTL, residential transition loan rate. So I think what you're seeing is originators finding new places to put focus on, and trying to figure out what this phase of housing looks like with the lower volumes. And I think if we take a look at where SoFi was, right, when you guys were starting out, pretty conventional product. You guys were mostly focused on student loans at that point and, making your first foray into mortgages. The credit box that existed back then, and that was probably 12 years ago now, to today, it's not even close. It's not even I remember one of the early things we worked on for you guys was you guys were trying to originate mortgages with a lot of the tech companies at that point, the Metas and the Amazons of the world, where you have a lot of young borrowers who are getting stock options. But at that point, there was not a loan program that really gave credit to stock options, right? And we put our head to that and figured out a way to prove, ATR compliance, to prove QM compliance while still underwriting those guys. That at the point seemed like such a big innovation. And now it seems like nothing to go ahead and underwrite someone who's getting a fair amount of stock in their compensation, right? So the market has changed a lot. I think, it was always going to be the case coming out of the GFC that the market had to evolve. And I think we're at a point where you're seeing a lot of innovation in product as people have gotten more comfortable and people are looking for yields and product.
Yeah, I say this while I'm on the road traveling around at conferences. It's almost been the best part of the doldrums we went through in this market cycle was that companies were forced to look at expanding their programs out there. They were forced to look at finding new and creative ways to qualify more borrowers. And I think it's good because you do have a really strong subset of qualified borrowers out there that maybe weren't being addressed properly in the mortgage, at
Hmm.
least in terms of providing liquidity. A lot of that's been remedied, and I think we'll continue to see a proliferation of these various products. And non-QM now, it's here to stay. And it's not that they're not a qualified borrower, it's just not a qualified mortgage. And so companies are
Right.
finding more ways to address that, which I find very encouraging, at least personally. But you're involved on the capital provider, bank partner, warehouse side of things. Obviously, companies are constantly looking for counterparties to provide takeouts, provide liquidity, those sorts of things. What should companies be looking for in a capital provider or partner or warehouse line? That's a really good uh, counterparty to do business with, that you want to do
Mhm.
business with, that values your needs and provides for them adequately.
Yeah. And I would actually love to get your take on what all is happening in the space, right? Because what I'm seeing is that you either have new lenders popping up in spaces like HGI, in fix and flip, in construction lending, or you have originators taking on products that they in the past have not done. And they're either looking for new equity takeouts, their warehouse line to accommodate that product, or just a loan buyer to act as a loan takeout, right? So I think as we're going through this transition in this sector, some of the important things that originators, I think, need to really consider as they're looking at capital partners, as they're transitioning their businesses, is really, do these guys have expertise in this product? Do they have expertise in residential lending? Do they understand the sector? And do they have a commitment to residential lending? Right. And I'm hearing a lot of stories of whether it's RTL guys looking for financing for the first time, and they're dealing with banks and bankers who, they're telling them, hey, this won't be a problem. We can go ahead and warehouse this. This is a product we understand. And then when it comes to closing on the line, as they're working through the docs, they're coming to realize, well, this is actually a banker who's only banked credit card receivables in the past, who's only banked something substantially different from residential lending, right? CRE, for instance, where, and then I think those guys over time run into trouble. And I'm hearing a lot of these stories, right? They get signed up with an ABL banker. Um, Once they start originating, they realize, hey, these guys don't understand wet funding. They don't understand how to fund at the table. They don't understand how to fund draws. They don't have the technology to help manage fundings. And it just becomes a nightmare, right? And I think as businesses are looking to transition, it is important to put focus on who you're partnering up with, because these transitions could go very messy, right? And you need guys that you can trust, who understand your business and who understand the product set well. But I mean, I love to hear your take, right? Because you're seeing it firsthand. All these originators jumping to new products. How's that transition going? How do you switch? How do you go take a jumbo loan officer and turn them into a DSCR guy? Turn that same guy into potentially bringing in fix and flip loans. Like, how's all that going?
I've seen it go both ways. I think
Hmm.
several months ago or a year ago, it was kind of companies that were doing well were focused on staying in their lane. And if I'm
Hmm.
and it could be certain originators within a company even. If I'm a DSCR guy, I'm a DSCR guy. If I'm
Hmm.
a, you know, conventional conforming right down the middle, that's my ballpark. That's where I go find my borrowers. Now it seems like it's expanded a little bit. Loans aren't falling from the sky. You can't go outside with a bucket and loans fall into the bucket anymore. And so
Yep.
it forces companies to
Yep.
reassess that. The second part of that, which it's almost a completely different tangent, would be there hasn't been a lot of profitability on the originations.
Mm.
And you would think with warehouse lines, normally it'd be, hey, if you're not profitable, you're not profitable, you're not profitable. Well, we're going to pull our warehouse line, and you're then going to have to notify counterparties, and it's going to set off this whole thing. Even
Hmm.
companies haven't been profitable. We haven't seen warehouse lines getting pulled. And so I
Yeah.
think it speaks to that understanding of the residential space or the relationship or those sorts of things. It makes it that much more important. And I don't really want to gloss over that point you just made about the working with a bank with residential experience. I think that that's vitally important. A bank that understands these sorts of things. At least that's where y'all come from, right? You have deep
Hmm.
residential experience, and so you feel like you're much more attuned to the needs and the happenings and the cycles of a originator, correct?
Yeah, for sure. And I mean, just taking Bank United as an example, right? We're not a residential mortgage originator, but we run an active correspondent program. We're opportunistic loan pool purchasers. We are very active in the non-agency RMBS space as CUSIP investors. And we have had a warehouse mortgage warehouse business for the last, I would say, 12 to 13 years now. And through that mortgage warehouse business, we're able to provide a warehouse line to your traditional independent mortgage bank, or we have looked at and done term financing to credit funds in the past, and provided leverage that way. Right. So having a team that can do all that, that can look at all that and understand what it is that your business is trying to do, I think is very key. I'm talking my own book here, but this is how we got to know each other. I think we were pretty instrumental in helping SoFi get off the ground with their mortgage business.
Totally.
And I think more than just purchasing loans, more than just providing a warehouse line and taking a look at niche products, it's also just providing expertise, providing advisory, providing a team where you can bounce ideas off of. Where we've done this business, we've looked at other originators, and we can tell you what's a good idea and what we don't think is potentially a good idea. And I think those things all matter. So I think looking for the right partner is worth the time. It's ultimately gonna affect whether you succeed or fail as a business.
Yeah, a lot of that is what the bank's philosophy is. But I want to talk you
Mhm.
personally a little bit here. Your area of expertise,
Sure.
kind of the day to day of how you assess your counterparties. What makes you, for lack of a better way to put it, sorry for being crude here, but like, good at what you do, your role, and those sorts of things.
Mhm.
Versus somebody that has less experience in this area.
Yeah. Yeah. I mean, my entire career has been in residential mortgages. I started out at a mortgage fund. We were doing, and this is before the GFC, we were doing subprime mortgages, scratch and dent, securitizing that through the crisis, looked at a ton of RPL, NPL, took that experience, came to Bank United. I've been, helping the bank build out a correspondent program since that time. We've built out warehouse business, and I'm also on the CUSIP investing side, right? So I think through all those experiences, having touched all those different parts of the capital stack and different parts of the capital flow, gives me an insight into what this business should look like, what it looks like at any given point, and it allows me to go into any originator or any credit fund that's looking for financing and understand their business right away. It's not, we don't have to, talk around what it is that they do for, multiple meetings. And no, I get it. I've seen it. I've probably financed it before. I live, breathe, and what is the saying?
Eat, sleep, breathe residential mortgages.
Yes, eat, sleep, breathe residential mortgages. There you go. This is all I do. This is everything that I do. So I think that's the kind of person you want, on your side, in your corner. Look, the difference is, if you take a look at COVID, right? I've heard a lot of stories of people getting their lines pulled during when COVID started, and stories of people getting margin called right in that beginning phase of COVID. And the reality is, if their lender had hung in there for 30 more days, everything was fine. COVID was a blip. It came and went pretty quickly in the residential mortgage space. And we got into a very profitable time after that. But if you're a partner with the wrong people and you get that margin call, you may not be able to survive that. You may not get to what 30 days after looks like. And, the difference is, if you're talking to someone who spent their entire career in residential space, they're going to fight for that business to stay open through COVID. If you're not, if you're talking to someone who does not have the same amount of commitment to the residential mortgage space, then who knows what happens to that line, and who knows how much they're fighting for you, come credit committee, come outgo, and whatever committee they have when they decide whether they're going to pull the line or not. So I think that is a big difference. I think that's something that people don't really see. That's more behind the scenes. But it's important, right? It's the survivability of your business does come down to, you know, whether your banker sometimes is willing to fight for you or not in those committees.
Yeah. And BankUnited's certainly lucky to have you. I know that. I think BankUnited knows that.
Yeah, I appreciate that.
I want to kind of put this all together, and I'll close with this. Everybody knows there's a housing shortage out there.
Yes.
Everybody knows we need to be building more homes. We haven't quite got a bipartisan action on it. Even if there's bipartisan consensus, there hasn't quite been bipartisan action from DC on how we can go about making that happen. I'll get political here for a second and say I don't think opening up federal lands to sale is the solution to that.
No.
But there are certainly ways that it can be addressed. I want your thought here, kind of in closing, on what has to happen in the residential mortgage space to address this shortage of housing, and then I guess kind of relate that to how the credit providers are viewing kind of this new evolution of what we can do to better serve the American homeowner.
Yeah, this is something I spend a fair amount of time thinking about because we've been in this higher for longer rate environment for a while now. And one of the things that this country is dealing with, right, is this housing shortage, like you had talked about. And depending on where you're looking, we're somewhere between 4 to 8 million units short in housing. And, we're starting to see certain products like RTL, fix and flip, get traction. Just last year, DBRS started rating RTL deals, and that's brought a lot of capital into that space. And, I think that's certainly a net positive for building more housing, for renovating more housing into livable conditions. I do think if we're tackling numbers in the 4 to 8 million range, it's a lot of units, right? And I think it's going to take a certain amount of innovation from the residential mortgage sector to get there. I think for one, I imagine construction lending people have to get more comfortable with it, and construction lending has to ramp up. I think, ultimately fix and flip is not going to address that number of units. You're just going to have to build more housing at some point. And there's just housing stock that is much too old to even be renovated at this point. I think that's one thing. I think housing affordability has to be addressed somehow. I think building more housing is certainly one way to do that. And I think, people are already doing things around the interest rate side. People are, there's buy down products that allow people to buy down their rates. You're seeing seller concessions in the space. So I think on the rate side, we'll always find a way, right? But it's really housing stock. Is there enough housing stock? Can you stem a little bit of the housing inflation tide that's been happening? And we're starting to see that housing inflation is starting to level off a bit already, right? And in some areas come down. But I think in the areas where people want to live, we got to build more housing, and it's gonna take some creativity from the investment world. I think we're just gonna have to figure out how to finance a lot of this building, and until we come to a product that can do that, I think it's yet to be seen what that's going to look like. But I think the RTL space is trying to address that.
Yeah, like I said earlier, at least there are a bevy of very qualified people out there that might not be able to be addressed by traditional methods, but now we're finding more ways to do it, whether that is the residential transition loans, whether that is the home equity investment loans, some of these products you touched on. Obviously, I know you'll be at the forefront of whatever it is, and I appreciate you bringing some knowledge to the podcast today. Always a pleasure talking to you and seeing you, and thank you very much.
Yeah, no, this was fun. And thank you for having me on.
Today's economic calendar is underway with Fed Chair Powell participating in a policy panel before the European Central Bank Forum on central banking. Later today brings the final June S&P Global Manufacturing PMI, the ISM equivalent, May construction spending, JOLTS job openings for May, Dallas Fed Texas Services, and some short-duration Treasury auctions. We begin Tuesday with agency MBS prices slightly better than Monday's close, the 2-year yielding 3.70 and the 10-year yielding 4.21 after closing yesterday at 4.23%. Let's wrap up with a joke and some housekeeping. So, it's the 4th of July night, and all the dead presidents are gathered around a campfire having a party. They're drinking and eating and just generally having a grand old time when President Washington puts President Lincoln on the spot. Hey, Lincoln, do that thing you do. What now? What thing? Do the thing, the speech, the thing. Oh, yeah, the speech. Yeah, that thing. No, I can't. Can't remember the words. What do you mean you can't remember the words? This is a speech. You've said it a million times. You got that, burned in your brain, right? Well, yes. Normally, sure, I've got it memorized. But that was 4 s'mores and 7 beers ago. Thanks again to Figure, which is shaking up the lending world with their 5-day HELOC, offering borrower approvals in as little as 5 minutes and funding in 5 days. Figure has hundreds of partners in the banking, credit union, home improvement, and of course IMB space embedding their technology, giving borrowers an experience they'll rave about. Learn more at figure.com.